Hello, this is Kurt Nielsen at eMortgage Hawaii, and this week I want to talk about three things. One is the rising mortgage rates and where we think that is heading. Two, housing. Do we expect housing prices to continue to rise, flatten out, or is there a bubble and there's going to be a burst? And third, the rumors of an upcoming recession. So let's get started. Okay, let's first start off with mortgage rates and really what drives mortgage rates. And the number one thing is inflation. So mortgage rates are married to inflation. It will follow inflation as it goes up and then as it goes down. So, we've seen inflation rise from 1.5% to 8.6%. So there's no wonder mortgage rates have risen from a low and below 3%. Now we're at 5.5%. Most people think that these Fed rate hikes are the reason why mortgage rates go up, but that's really not the case. They are only affecting short-term lending rates. But their balance sheet runoff does have an impact. And what that means is the Fed was buying mortgage-backed securities and treasuries. They stopped doing that. So that pushed rates up because there's fewer buyers. But now they're also letting their balance sheet run off by about 90 billion a month, which means when a mortgage pays off, they don't take that money and go reinvest it. They just let it pay off. And then we would like to talk about the past history of recessions and what we can draw, what kind of conclusions can we draw from the Fed's activity in past recessions. Okay, so let's talk about inflation and why we feel that inflation will remain high until we see the October inflation numbers. And it's really just about the math. We expect by March of 2023, we'll start seeing much lower inflation figures, and hopefully throughout 2023, inflation should come down, as will mortgage rates. And this is why inflation is calculated by just adding up the last 12 months of monthly inflation, okay? So in April, we had a really nice low number followed by a monster number. We'll see how this all plays out. But in May and June of last year, we had 0.7%, 0.9% monthly inflation. Now, if May and June of this year come in lower than these numbers, we'll see inflation dip a little bit. But look what happens this summer. We're going to drop off some low months. And if the inflation this summer in 2022 is higher than these numbers, we'll see inflation go back up. It's not until we start dropping these bigger numbers that we will see inflation come down, as long as the monthly inflation is lower. So when the October number of 2022 comes in and if it's below 0.9, then we could see inflation start dropping down. We get to drop off these numbers and then look at March. If we can drop off that number in March of 2023, then we could see some real dips. So it's really going to be hard to see a big movement in inflation until we get to start dropping off these big numbers. We see that happening in spring of 2023 throughout 2023. So we're going to have higher mortgage rates until then, but maybe some relief heading into the end of the year. So let's look at what the Fed has to do, especially with recession. So if you go back to Arthur Burns in the late 70s and Volcker, Burns watched inflation just rise from 7% to 14%, didn't do anything about it because he thought it was transitory. And again, mortgage rates followed. Volcker stepped in and said, no, we're going to raise the federal fund rate, slow the economy down. He pushed federal fund rate from 11% to 20%. Inflation responded, dropped from 14 to 5. So did mortgage rates, but that pushes us into recession because that's what happens when the Fed raises their Fed fund rate, slows the economy down, and they overshot and went into recession. So Greenspan, he was a little more quick on the trigger, saw inflation rising 1.7 to 3.5, mortgage rates followed, Fed funds rate went up almost 2%. Inflation responded, dropped all the way down to 1%, and then so did mortgage rates. But again, pushed us into recession because it has a habit of slowing the economy down. Now Powell has seen inflation rise from 1.5 to 8.5%. Mortgage rates actually higher than that now, 2.5 probably to 5.5 right now. And the federal funds rate we're expecting in 2022 to go from 0 to 3%. And the inflation response should be to start dropping near the end of this year, and same thing with mortgage rates. But if you follow these other examples, slowing the economy down could put us into recession. The question is it going to be a soft landing? Who knows? But there's a lot of other things happening in the world today that could affect how big of a recession we head into. So this is another chart that shows that the federal funds rate really doesn't drive mortgage rates. Here we had the Fed hike, federal funds rate, mortgage rates declined, then they started going back up, the Fed hiked again, decline, hike, decline, hike, little went up, decline. What really is impacting mortgage rates is this balance sheet of the Federal Reserve. When they start letting it run off, that tightens the money supply, and then increasing the runoff, and sure enough, mortgage rates shot up. Even though there was a couple of Fed hikes, the runoff on the balance sheet just kept pushing mortgage rates higher. You had a couple of rate hikes, started seeing mortgage rates come down, but when the Fed stopped running off their balance sheet, that's when we really see the dramatic drop in mortgage rates. So again, the federal funds rate is not driving the mortgage rates. It's more of the money supply, tightening the money supply that will drive this, and inflation. So another thing that we should be looking at when it comes to inflation is what we call an inversion of yields. So we monitor this by taking the yield on the 10-year Treasury minus the yield on the 2-year Treasury. If that drops below zero, that's a pretty good indicator we're going into recession. So what that means is, normally you'd think that if you tie up your money for 10 years, you should get a higher interest rate than if you tie it up for 2 years. When that goes upside down, it doesn't make much sense, but that usually means that we're seeing some problems. And sure enough, we had an inverted yield curve over here in April. And if you look in the past, usually when you get an inverted yield curve, recession, 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 tiny real recession. So we're kind of here. We're going to keep a real close eye on this yield curve. And if it goes inverted again, then you're probably looking at an upcoming recession. And another indicator is unemployment. It's really interesting. So when unemployment bottoms out and starts rising, we have a recession. It happens every time. Bottom out, rise, recession, bottom out, rise, recession. It happens every time. Every time. Bottom out, rise, recession, bottom out, rise, recession, bottom out, rise, recession. So now this is kind of an anomaly with the pandemic, but we are pretty low. If we see unemployment turn around from 3.6%, which is today's unemployment rate, and starts rising, you're pretty sure you're heading into recession. And here's an interesting statistic. 100% of the time that the U.S. has had 100% of the time the U.S. has had a recession when unemployment rate drops below 4% and inflation rises above 5%. Well, that happened in April. So again, that's where companies start seeing the economy slow down. They've hit a bottom on unemployment, and then they start letting people go. Unemployment goes up in a high inflationary environment. The Fed is acting, trying to slow the economy down. They're a little late to the party, and we head into recession. So what happens to mortgage rates during recessions? Well, you can see they normally drop. So if we do go into recession, it's not bad for mortgage rates. So that's something to watch. So you can see the drop here, the drop here, the drop here, the drop here, here, and here. Okay, now let's talk about housing. So housing normally stays pretty strong through recessions. It certainly doesn't drop like the equities market. So if you look at all these recessions, housing has weathered very well during many recessions, except for the 2007, 2008 recession. And why is that? Well, this is when housing became completely unhinged from market fundamentals. We were overbuilding housing for a false demand that was created by financing people who couldn't normally get financing. I remember a bartender buying 3 condos. He didn't need 3 condos. He couldn't live in 3 condos. He was just speculating that if he bought 3 condos a year later, they'd all go up in value and he'd cash in and make a lot of money. So what we are doing is creating a false demand in the marketplace and overbuilding in the marketplace. And we're going to show some other numbers here. We're in a completely different situation today, and we're going to show you these numbers. So right now, housing is really tightly hinged to the market fundamentals, and you can just project where housing prices are going to go. So this is a chart showing in 2007 that we had an inventory of properties on the market of 3.7 million. The average is about 2.5 million. We hit a low of 870,000 units in inventory. I don't think it's ever happened. So we have very few properties available, and we're still way behind in construction. During that time, we've had 14 million new households added to the country. So we have 14 million new households, 3 or fewer homes in inventory, 3 million fewer homes in inventory than back in 2007. So the fundamentals are completely the opposite. We have excess demand and not enough supply. And this is all driven by construction. So back here, we need about 1.5 million homes to keep up with the population of the US. We're way above that here. The collapse happened, and look at this. We dropped down to like 500,000 homes being built, 1 million homes a year behind population growth. Well, that catches up with you. So we finally get to here and started exceeding it a little bit. And you say, well, now we're overbuilding, but we're so far behind. You look at the amount of inventory that we're going to need to build to catch up. We're about 4.5 million homes behind. If you build 2 million homes a year, that's 500,000 over the need to just keep up with population. It'd take us 9 years to catch up. So do we think housing is going to burst? No. Do we think housing is slowing down? Yes. That's being driven by interest rates and a little bit of buyer exhaustion. So we see home escalation slowing down, but still escalating. So buying housing today, certainly if we go into recession, the stock market will come back down, but I don't think housing is coming back down. So I still think housing is a very good safe place to invest in. And then if you buy now and wait 18 months, you can refinance and get a much lower rate. So that's where we think we are. So I appreciate you being with me today. And if you have any questions, give me a call. I'm at 808-334-6201. Again, 808-334-6201. Thank you.